Here at the Colat Business School in the Colat Tutoring Lab. You can reach us here at colattutorlab@uab.edu, or you can reach us on Skype at colat_tutor and arrange a personal Skype tutoring session. Today we're going to cover Chapter 8. Chapter 8 covers long-term assets. Now, when I get down here to these explanations about plant, property, and equipment, it is a hugely long and detailed explanation. So we're going to actually post these Word documents and the Excel document. I would highly recommend that if you're not comprehending this, that you either pause and read it, or that you download these and read them, because there's a lot of topics covered on, there's a lot of information on very few topics. Long-term assets. Chapter 8 covers long-term assets such as plant, property, and equipment, or PPE, also known as plant, property, and equipment. These are considered tangible assets. That means they have a physical presence. There are other long-term assets that are considered intangible assets, patents, copyrights, goodwill, to name a few. Intangible means they do not have a physical presence. You cannot reach out and touch them. It also covers various means at which these long-lived assets cost are depreciated, amortized, depleted, or impaired over time. Basically, every one of these things that I'm highlighting right now mean the same thing. They just are a way of saying depreciation, but to different types of assets. Plant, property, and equipment, also known, again, PPE, also known as plant, property, and equipment, are physical long-term assets that are also non-current assets that have an expected useful life of more than one accounting period. Most of these assets also have an associated means of decreasing the value of these physical assets, known as depreciation. Depreciation is considered an expense. When you first purchase a long-term asset, you would debit your long-term asset that you're acquiring, and you would credit your cash. And that would be a neutral adjustment to your balance, to your asset side of the equation. So there's no expense involved. That's what the depreciation for is, to carry down the cost of the expense of that and spread it out over the useful life of the item that you are discussing depreciation on. However, land, does not depreciate ever. Land does have one particular exception to that, and that is if you make improvements to the land, such as adding shrubbery, fencing, and other such modifications. Those additions do depreciate using whatever depreciation model you use. We will discuss depreciation and its many variations later on. PPE, plant, property, and equipment, is always recorded at historical cost and usually only depreciates in cost or suffers an impairment that decreases cost. The exception to that rule is when you make betterments, also known as improvements, which make that particular asset more efficient or more productive, or two, additions to an asset that increase its size. Example, adding a wing to a warehouse. Or three, extraordinary repairs that extend the life of that particular asset. I don't have it written up here, but I want to throw in very quickly, ordinary repairs to any plant, property, and equipment are just expensed when you incur the expense. You don't do anything special with ordinary expenses. Betterments, improvements, or addition costs are debited to that asset's particular account, and the costs are capitalized. The new book value minus salvage value, if any, are then depreciated over the asset's remaining useful life. This is the only time that your historical cost on how you keep your plant, property, and equipment would increase in value. The only time that you get to notice that or appreciate your plant, property, equipment is when you sell it and if you make a gain. But that is only at selling time. At no time during the bookkeeping process do you get to appreciate your PP&E unless you do a betterment, an addition, or a extraordinary repair. Extraordinary repair costs are debited to that asset's particular account, and the costs are depreciated over the remaining new extended useful life. If you remember what we said about extraordinary repairs, they extend the life of that particular asset. You go in, you put some new seals in it, some new cutting rods on your iron press, and that extends the life of that asset. It means it's not going to wear out now in 5 years, it's going to wear out in 6 years. So you would repair costs are debited to that particular account, and the costs are depreciated over the remaining new extended useful life. Intangible assets. We are going to talk about those a lot. Intangible assets are non-physical assets that can have either a limited life or an indefinite life. If they have a limited life, the costs are allocated over the time through the process of amortization. If they have an indefinite life, such as goodwill, the amount paid by which the company's value exceeds the value of its individual assets and liabilities. That means you went and bought a company for $2 million. But its assets, its individual assets and liabilities were only worth $1.5 million. That means you're carrying $500,000 worth of goodwill. Goodwill can only be impaired. They do not amortize over time, but they can suffer an impairment or, in some cases, change class from an indefinite life to a limited life, thus meaning they either become impaired for an indefinite life asset, such as goodwill, or they start to amortize over the term of their limited life. For example, a patent that maybe at one point you owned it in perpetuity, or you thought you did, and then you found out actually you can only own a patent for, I think it's 20 years. So you would then have to start amortizing the cost of that patent over the term of its limited life. Amortization of intangible assets has the same relationship to intangible assets that depreciation has to physical assets. However, amortization, when used for limited life intangible assets, can only use the straight line method of depreciation, or in this case, straight line method of amortization. I will go over that in more depth when I change over to the Excel sheets. You can only change from that straight line method if a better method can be proven. That means you have to actually show your auditors why using double declining balance or some other method of depreciation / amortization is better. And your auditor actually has to sign off on that. So On page 352 through page 354 in your text, there is a more comprehensive listing of intangible assets and what they are. I will leave that to you to read about. The last thing I want to talk about very quickly is depreciation, amortization, and depletion. Depreciation, method for allocating cost of physical assets that are usually included in your long-term asset category in PPE. Amortization, method for allocating cost of intangible assets with limited lives. Remember again, if it's got an indefinite life and it's an intangible asset, there are no changes made to it. Depletion, this is an important one. Depletion is the method for allocating costs of natural resource assets such as oil or coal or gold or anything of that nature. These above three items that I have bolded are basically the exact same thing, just differentiated by what type of asset they are attached to. Depreciation, amortization, and depletion basically all mean the exact same thing. They just have a different asset class that they can attach to. Okay? We're going to now go over to the Excel worksheet that I have. And we're going to talk about depreciation methods. Our first one is going to be straight line depreciation. I based this off of Exhibit 8.6 on page 340 and used that as the inspiration for the beginning numbers, and then I just ran it out for the full 5 years. I do change the colors so that you can see that it's awful hard to read if it's just all one base color. So I wanted to make sure everybody could get to it right. So straight line depreciation is costs minus salvage equals, in this case, your cost was $10,000, your salvage value was $1,000, and that left $9,000 to be depreciated over 5 years, useful life in periods. That would give you a $1,800 per year depreciation expense and add $1,800 per year to your running total in the accumulated depreciation. If you remember from previous chapters, when we do our closing from trial balance and start making out our income statements and all of those other things, expenses and revenue accounts close at the end of the time period. They do not carry over to the next period. So when I'm showing these, I'm just showing you what the year-end balance is, and like here, I don't know what the revenue would have been, so I just have it empty. But we all know that revenues and expenses are closed at the end of the year. They don't carry from year to year. So journal entry in year one, we have depreciation expense of $1,800. We have accumulated depreciation being credited at $1,800. Remember, accumulated depreciation is a contra asset account. That means that it is increased by adding to the credit side of the equation. As we all know, depreciation expenses are always increased by debiting. So what we are doing is we are increasing our depreciation expense, and we are increasing our accumulated depreciation. I have accumulated depreciation down at the bottom of the 5-year period just to show you that what would happen. So then, to close out depreciation, we would credit revenue, we would debit revenue, which has a negative effect on revenue, and we would credit depreciation expense, which would zero out the balance of the year-end total for your depreciation expense account. I'm using T accounts because I find those the easiest to use. This is year one. Now, here on revenue, $1,800 debit from the from the there's an $1,800 debit from the, I have these reversed, excuse me on that. It's going to be carried down throughout the whole thing too. I need to reverse those entries for you, but I think you can understand. So you've got a negative balance right now to your revenue account because I don't know what the revenue for the year was. Year 2, exact same thing goes on, nothing changes. Depreciation expense gets debited here, gets credited there, and we're off to the races. And then we are debiting our revenue. Actually, I do have these right, I'm sorry. These are all right. I'm getting a little loopy. I think I've been doing this too long today. Year 3, exact same entries. Year 4, exact same entries. Year 5, exact same entries. Here's where your T account for accumulated depreciation. In year 1, you had $1,800. Year 2, you added an additional $1,800. Accumulated depreciation is a balance sheet account, and that means it carries its balance over from year to year. So this is going to be carried for 5 years in this case because we used 5 years as our depreciation basis. So 3 years, we got $5,400, $7,200, $9,000. It is fully depreciated, zero remaining to be depreciated. Salvage value is $1,000. So this on your books right now would be being carried at zero value with a salvage at zero cost with a salvage value of $1,000. If you were to sell it, say you sold it for $1,000, the salvage value, you would go to your multi-step income statement and that would actually go into your other gains and losses. Okay, now we're going to go to a different type of depreciation method. We're going to units of production depreciation method. I'm using Exhibit 8.9, page 342 in your text. Feel free, pause this, go to that page and look at this so that you can see what I'm doing while I am explaining it to you in case you can't see this very well or very clearly. I'm going to try to expand it or enlarge this a little bit. Whoops. That ought to be a little easier to read. So, whoops, we're going to need to move that back. All right. So, units of production depreciation method. Step 1, cost minus salvage equals, again, we're using that same $10,000 minus $1,000 of salvage value, which gives us $9,000 here, and total units of production, which is 36,000. So 36,000 divided into 9,000 gives you a cost of 25 cents per unit. So step 2, we're going to go down to depreciation per unit times units produced in period. So we have 0.25 or 25 cents per unit times 7,000 units gives us a depreciation expense of 1,750. This is what the journal entry would look like. Depreciation expense 1,750 as a debit, because we always debit expenses to increase them. Accumulated depreciation would be 1,750, and it's a contra asset account. Again, remember, it is a contra asset account, so it carries a credit side balance. So we would get there. Now I'm going to do double declining balance depreciation. And I actually worked this all the way down through the 4-year period or the 5-year period. This is based off of examples 8.11 and 8.12 on page 343. Again, pause if you need to, go to that page because you really need to understand what's happening here. So step 1, straight line rate, 100% divided by the useful rate, 100% divided by 5 years equals 20%. So double declining balance rate equals 2 times the straight line rate. That was the straight line rate, so 2 times 20% means we're going to depreciate it by 40% in every period going down, for every year going down for the 5 years that it takes to reduce this. That means we're going to take a lot of depreciation expense up front, and then we're going to take less as we get towards the end. So here's our first journal entry for the year 2013. Depreciation expense was $4,000 because you take 40% of $10,000 and you get $4,000 for the year 2013. So that's your depreciation expense. Again, we're debiting it, so it is coming off as a debit, and we are crediting it to accumulated depreciation. Again, a contra asset account that is increased by debit or credit side entries. Year 2014, double declining balance rate equals 40% times beginning period book value of 2014. You take the 10,000 minus out the depreciation we did the first time, that gives you the beginning book value for the year 2014. So 40% times 6,000 equals $2,400 of depreciation expense for a year 2014. We go to depreciation expense, we are debiting it, and that is how you increase the expense. And I know I keep repeating this, but this bears understanding that you have to make sure that you're making the appropriate side of the entry. So to increase depreciation expense, we debit it, and to increase accumulated depreciation, we credit it. So that's year 2014. We're going to go on up here to 2015. Well, let's get 2014 so you can see it for a minute. So double declining balance rate equals 40% times beginning period book value for 2015. 6,000 minus the 2,400 that we paid in depreciation leaves us with $3,600 as our beginning period book value. As you notice, our depreciation amounts are decreasing rapidly because we took the vast majority of it up front as fast as we could. Now, so in 2015, we're actually only going to take $1,440 in depreciation expense, and we're going to increase accumulated depreciation by $1,440. Again, contra asset account, don't forget to credit it. All right, so now we're down here to 2015, we've just done that. And we're down to 2016. You take the 3,600 minus the 1,440 that we paid in depreciation. That leaves us a book value of $2,160. Now, 40% of $2,160 is $864 of depreciation expense for, that's meant to be 2016. Sorry. That was meant to be 2015. Wow, I really messed up on that. That is a true mess up. That's supposed to be 15, like it says there. And it's supposed to be 2016 there. Probably won't surprise you that I did some copy pasting there because they're very similar transactions, and I just forgot to change that number. So we have depreciation expense of $864 in the year 2016. We increased accumulated depreciation by an additional $864. You take that $2,160, subtract the $864, that is the fourth year's depreciation expense, and you go to 2017. 2017, 40% of $1,296 actually is more than $296, but we cannot depreciate below the salvage value, and the salvage value is $1,000 from that problem. So we can only do that 296 down or added to the depreciation expense for the year, and then an additional 296 to accumulated depreciation. Now here I have an accumulated depreciation chart showing that in the first year, our depreciation was $4,000. Take that away from the 10 that we had, and you have $6,000. The next year, we did $2,400, if you remember from up there. You take the 2,400 from the 6,000, you get the 3,600. And as you can see, we keep adding that up until it reaches the $9,000 mark, as it does in 2015. And you can see what our book value was at each year. This was our initial book value of $10 million, or I'm sorry, $10,000. And then these are the depreciation amounts as they came out. 4,000 there, 2,400 there, 1,240 I think it was, something like that. 1,440, then 864, and then the 296. We have fully depreciated. There's zero remaining to be depreciated, and salvage value of $1,000. We cannot depreciate below that. Again, if you pay attention to this note I made here with the star, 2017's depreciation is only $296 because you never depreciate below the salvage value of the item. Okay, this pretty much concludes Chapter 8. My name is Dennis Brooks. I'm a graduate student here at UAB. I am a tutor in the CoLat Tutor Lab. You can reach us here at colattutorlab@uab.edu, or you can reach us on Skype at colat_tutor. Thank you, and good luck with Chapter 8.